Okay, let's continue with still with number 3. If you have the consideration transferred, the assumption given is that if a pop company issued 100,000 shares with a market value of 100, so it's 10 million, then we have the estimated liability for contingent consideration that's given at 8 million. The total consideration transferred is 18 million. We deduct the current assets and the investments, land, buildings, equipment, and identifiable intangibles at market values, and deduct the current liabilities and long-term liabilities. So the positive, it says, or the goodwill in case number 3 is equal to 500,000. In number 4, assume the same facts as in requirement 3. Before the contingency period is over, the estimated value of the earnings contingency declines to 7.8 million. Prepare PAPS entry for letter A. The value decline occurs within the measurement period. In B, the value decline is due to events occurring subsequent to acquisition. So in number 4, letter A, we now debit to estimated liability for contingent consideration in the amount of 200,000. That's 8 million minus 7.8 million. And we credit to goodwill, reducing goodwill by 200,000, considering that the book value decline occurs within the measurement period. In the case of letter B, the assumption is the decline occurs subsequent to acquisition. Our debit is still the same, but the credit is to retained earnings or gain on acquisition, and it's not to goodwill. So that makes a difference depending as to when the decline occurs. Okay, so we have now number 3, problem number 3. Then I'll continue with the problem number 4 with the 2 requirements. Number 1, determine the amount of goodwill. And number 2, assume that during March 20x5, new information comes in regarding the value of Sandy's property, plant, and equipment on the date of acquisition. It's determined that the property was actually worth 1.5 million less than previously estimated. Make the entry to record this new information. So we now begin with problem number 4. In number 1 requirement, determine the amount of goodwill. So we now record in on January 2, 20x5, we now debit cash and receivables for 200 million, then inventories for 400,000. The given amount of inventories is 600,000. However, in accordance with the additional data stating that an analysis of Sandy's assets and liabilities reveals that book values of some reported items do not reflect the market value at the date of acquisition. The inventories are overvalued by 200,000. So if the inventories are overvalued by 200,000, the given initial amount of inventories 600,000 minus 200,000, we now record the inventories at 400,000. The property, plant, and equipment initial amount of 7.5 million. However, the property, plant, and equipment is overvalued by 2 million. So, we record property, plant, and equipment only for 5.5 million. Then we have the customer contracts, which are not currently reported on Sunday's balance sheet in the amount of 25 million, in process, research and development valued at 300 million. Goodwill is initially blank. We have to compute it as a balancing figure or based on the computations below. Then we record now the current liabilities of Sandy of 400 million. The long-term debt is initially 7.2 million. However, it stated that the recorded expected future warranty liability still is 10,000. And we have another 100,000 to be added as a given amount of your long-term debt. As stated, the long-term debt is undervalued by 100,000. So we are now crediting the long-term debt a total of 7.3 million after the adjustment. Then we credit warranty liability by 10. That's for the future warranty liabilities, and estimated liability for contingent consideration given at 50 million. That's on the last sentence, and the common stock is 700 million given January 2, 20x5. Okay, so we have to read the topic items included in Goodwill in Chapter 1 about skilled assembled workforce. They are not identifiable at the date of acquisition and potential contracts. They are not qualified as assets at the acquisition date. So we have now the computation of the applicable amount of positive excess, which is goodwill. We have now the consideration transferred given at 700 million. Then the estimated liability for contingent consideration given at 50 million. From the total, we deduct the market value of assets and liabilities, cash and receivables 200,000, inventories after adjustments 400,000, property, plant and equipment, customers contracts in process, research and development. Then we deduct current liabilities and long-term debt and the warranty liability, leaving us the amount of 1,285,000. That's now your total of the market value of net assets. So the difference is 2,035,000. That's now your positive excess or goodwill that we are going to debit to goodwill, or the positive excess of 2,035,000. That's now in question number 1. Determine the amount of goodwill. So goodwill is a debit. Then we record acquisition related expenses given at 150,000 and credit to cash. However, the cost to issue and register the stock premium, or that's debit to APIC and credit to cash. Then we have to record 100,000 as your acquisition related expenses, but we have now the 100,000 registration fees that we normally debit to APIC and credit to cash. Then second entry for assume that during March 20x5, new information comes in regarding the value of Sandy's property, plant, and equipment at the date of acquisition. It's determined that the property was actually worth 1.5 million less than previously estimated. Make the entry to record this new information. We now debit to goodwill and credit to property, plant, and equipment that is overvalued. So meaning the corresponding debit should be made to goodwill for entry number 2. Okay, that's all for problems 3 and 4. We now go to problem number 5. Problem number 5 is quite a very long problem with requirements number 1 up to number 8. So let's see if we can finish answering the problem with sub-requirements. So we have now requirements 1 up to number 8. Okay, with sub-requirements. So that's only requirement number 1. We have requirement number 2, number 3. Number 3 has sub-requirements. Okay, so that's number 3. Number 4. Number 4 has sub-requirements. Then we have number 4C, D, followed by number 5A, 5B, 5C. Okay, that's number 5, 6, 7, 8, 8. Now 8 and it's a long set of problems. So with number 8. Okay. So that's all for problem number 5. We will try if we will be able to finish problem 5, or I'll extend a little time just to finish discussing the solutions to problem number 5 with all the requirements. So far, number 5 is the longest among the problems in chapter 5. So we have now problem number 5. Let's begin with requirement number 1 with sub-requirements, and we go on with okay, so requirement number 1 for problem number 5. So number 1 has sub requirements A, B, and C. Okay, so let's now begin with requirement number 1. Okay, so in requirement number 1, on December 31, 20x4, determine the amount of goodwill, prepare the entries required in the books of the acquirer, pure in relation to the acquisition of Saint Corporation. Prepare balance sheet immediately after the business combination. Now, comprehensive problem, goodwill computation with contingent consideration. On December 31, 2004, Pure Corporation enters into a business combination by acquiring the assets and assume the liabilities of Sane Corporation, in which Sane Corporation will be dissolved. Pure consideration transferred consists of the following: A. 300,000 unissued shares of its 10 par common stock with a market value of 25, 180,000 in long-term 8% note, and a contingent payment of 120,000 cash on January 1, 2007 if the average income of uh, during the 2-year period of 20x5 and 20x6 exceeds 300,000 per year. Pure estimates that there is a 30% chance or probability that the 120,000 payment will be required. In addition, Pure pays the following at the time of the merger: finder's fee, accounting fees, legal fees, cost of SEC registration, accounting and legal fees included, cost of printing and issuing stock certificates, indirect cost of combining, including allocated overhead and executive salaries. The balance sheet and the fair value information by the two companies on December 31, 20x4 immediately before the merger are as follows. So we have now the balance sheet accounts of Pure and Sane with their book values and fair values. Okay, so we now begin with requirement number one, is the computation first of the positive excess or goodwill. So we have now the consideration transferred for the common stock, that's equal to uh, 30,000 shares at 25. So that's now in letter A. Uh, 30,000 unissued shares with a market value of 25. So that's now for consideration transferred of 750,000. Then we have the notes payable of 180,000. Again, that's given. And the contingent consideration, cash contingency, 120,000 multiplied by 30 percent probability, 30% probability, a contingent payment of 120,000 cash on January 1, 2027 if the average income of during the 2-year period exceeds 320,000 per year. Pure estimates that there is a 30% chance of probability that the 120,000 payment will be required. So that means 36,000. The total consideration of 966,000, we now deduct a fair value of identifiable assets acquired and liabilities assumed. We now have cash. In the books of Saint, the fair values, cash of 24,000, receivables of 48,000, inventory 72,000, land 240, buildings 360, equipment of 300, and we have the in process research and development in the amount of 60,000. We now have accounts payable deduct 72,000 and 168,000. So the total of fair value of identifiable assets of 864,000 deducted from the total consideration. We now have the positive excess or the goodwill of 102,000. So, in requirement letter A, determine the amount of goodwill. So, goodwill is 102,000. Now, in letter B, prepare the entries required in the books of the acquirer in relation to the acquisition. So, we now debit cash, recording all the uh, net asset accounts, cash, receivables, inventories, land, building, equipment, research and development in process, and recording goodwill computed in letter A of 102,000. We now credit to accounts payable for the amount of 62,000. Then we have other liabilities for 168,000. We have notes payable for 180,000. Estimated liability for contingent consideration in the amount of 36,000. Common stock now is 30,000 shares times 10. Then the paid-in capital is 25. The market value minus the par of 10. So we now have the amount of accounts payable and other liabilities here. Accounts payable is recorded at 62. That's 62,000. Make correction. Accounts payable at fair value is 62,000. So here we have accounts payable at fair value equal to 62,000 for it's actually with a given adjustment or accounts payable. Here we have the total of the cash, adding cash and receivables. So if you have to get the totals of cash and the receivables, and we have the inventories, land, buildings, and then the equipment, the in-process R&D of 60,000, and the goodwill of 102,000, and the accounts payable, other liabilities, 168, and the notes payable, 180, estimated liability of 36, and then we have the common stock of 300 total. Let's try with the debit side. Debit side total of 24 and 48 is 72. Then 72 and 240 is 312, 360, and 300 is 660 plus 60 is 420, and then we have 102. So that makes a total equal to carry 906,000 for 8 906,000 for the debits. Then the credits, we have 220 for the credits of 220, 180 plus 36 is 216 and 750. So that's now for a total of 3, 8, 4, 11, 1186. Now, if we have the total of the credit side, 62 and 168. That's 230. Then 180 plus 36 is 216. 300 and 450 is 750. That makes 6. 4, 9, 4 plus 7, 11, 1196. And the debit side total 24 and 48 is 72. 72 and 240 is 312. 360 and 300 is 660 plus 60 is 720 and 102. So the total now is 6, 8, 10, carry 1, 4, 11. So that makes 1, 196. Okay, so the credit side. Now, make correction. Your accounts payable is 72. 72. Accounts payable, credit side is 72. It's actually 72. So, repeat, make correction. Accounts payable is a credit of 72. So we have now the explanation in letter B, the acquisition of Sane Company by Pure Company. Now we record the acquisition related expenses, 78,000 of the direct cost of 78,000 and credit to cash for the direct cost in the amount of 78,000. So that makes 12 plus 24, 36 plus 42 is 78,000. Then we now debit to for the registration expenses 18 plus 14,400 is 32,400. That's now for APIC, debit to APIC and credit to cash. And the last here is debit to cash, and here again 27 600. That's for your acquisition related expenses, and finally credit to cash for the last amount of 27 600. Requirement letter C, prepare balance sheet immediately after the business. Pila pa ka minutes? 20. Butang ta may extend pa ko 30. Dapat maubos. Tugid ni lawig ni Mick. Ihan. Okay, let's continue with number 1, letter C. Prepare the balance sheet immediately after the business combination. So we have now the balance sheet with the cash. Now in the books of Pure Company, and now combined with the Saint Company. So we have the amount of cash in the amount of only 162,000, because the initial amount of cash of Pure is 276,000. However, we have the acquisition related expenses. So we have now cash of 24,000 from Saint. So we are adding 24,000. The initial amount of cash of Pure is 276. We are adding the 24 of Saint. So that makes a total of 300,000. That's for the additional. Then we have the credit of cash equal to credit by 78,000, leaving us 222,000, and then debit. We have another debit for cash, credit for 32,400. So we have now 189,600, and another for 27 600. So we have now the remaining cash of 162,000. Okay, so 162,000 is taken. Initially adding 276 at the beginning cash of Pure and that of Saint of 24. So we now get the total of 300. We deduct 78, deduct 32, 400, and deduct 27, 600. The remaining cash of 162,000. Then we add the receivables of the two companies, total 144,000. The inventories of that of Pure, and we have the inventories of Saints. So we now have the total of 360,000. Now the receivables of Pure of 144. Okay, the inventories, and we have land for 348,000, 348,000, and then buildings 840, equipment 732, in process research and development 60, and goodwill 102. For the liabilities, accounts payable for 288, other liabilities 408, notes payable 180, estimated liability for contingent consideration 36, and the total liabilities. Then stockholders equity, common stock at 10 par, paid in capital in excess, and retained earnings, and the total stockholders equity, total liabilities, and stockholders equity. Now you have the miscellaneous computations at the bottom. It should be noted that under PFRS 3, in process R&D is measured and recorded at fair value as an asset on the acquisition date. The requirement does not extend to R&D in context other than business combinations. So we now go to requirement number 2, provisional amount on asset acquired. Assume that the value of the building was provisionally determined on December 31, 2004. On August 1, 20x5, Pure Corporation received the final value of the independent appraisal, the fair value at acquisition date being 384,000. Determine the amount of goodwill and prepare the required entry to reflect the adjustment, if any. So in number 2, assets that have been provisionally recorded as of the acquisition date are retrospectively adjusted in value during the measurement period for new information that clarifies the acquisition date value. The adjustments affect goodwill since the measurement period is still within 1 year, 8 months from the acquisition date. Therefore, the goodwill to be reported then on the acquisition should be 102,000 minus 24. So we have now the building to be adjusted by 24,000 and we credit to goodwill. So that's the amount of 24,000. Pure Corporation received the final value upon appraisal. So the value of the building is 384,000 against the initial fair value of 360. So this should be added by debiting building, so that makes it 384 and credit back to goodwill, adjustment to goodwill due to measurement date. Now we go to requirement number 3 with the requirements A, B, and C. Cash contingency based on future earnings with measurement date rule. Assume that on August 31, 20x5, because of improved information about facts and circumstances that existed at the acquisition date, the contingent consideration was revised to an expected value of 60,000. So determine the amount of goodwill, prepare the required entry to reflect the adjustment. So we now have in requirement the goodwill to be reported on the acquisition should be 102 plus 24. So we are now the contingent consideration as stated is made equal to 60,000. So we now debit to a goodwill for 24,000. Then the estimated liability for contingent consideration. That's now equal to a credit of 24,000. Now, initially, we have 36,000. So, we now get uh, in letter B, the adjustment is now to debit goodwill 24,000 and we credit to estimated liability for contingent consideration in the amount of 20